So this is like a sequel to the yesterday's video in which I spoke about this GTT order. Okay, the GTT sell order. Why do we use GTT sell order? To keep a proper stop loss to cut the position in case the trade does not go in our favor, or like this, if the price goes up and you want to protect your unrealized gain, in that case you could keep that GTT sell order at a price which is above the break even price. Those are the two main practical applications of the GTT sell order. Okay, that's a part of trade execution because we need to do partial selling, especially in positional trades. We need to do partial selling. If the stock goes up, it could form another base. While it is forming another base, we don't want to sit tight with all of the shares we have. We might want to take some money off the table because the next base could last like 2 3 months. So the money is stuck there, right? So protecting unrealized gain and then protecting capital by keeping a proper stop loss. That's GTT sell order, part of trade execution and trade management. Okay, that's the application of GTT sell. In this video, we will look at GTT buy because this is pure trade execution. This is not about trade management. This is pure trade execution because we are trying to buy the stock in the yellow band. So let me draw the yellow band. So this is the base. I have drawn the base properly here. And let's say the buying price is 100. So I will remove all this. Let's say the buying price is 100. So what I do is I buy another yellow line. Let's keep it here. Okay. Let me give it yellow color, and this is 101, correct? Because if 100 is my, what happened? 101. What happened? Where are the yellow lines? Sorry, it went below because it is tracking this price. Anyways, I will manually put the prices here. Here one and here one. Okay. So this is 100 and this is 101. Correct. So now we have this yellow band. The goal is to buy the stock in that range. So when the stock from here, when the stock starts to go up, there are multiple prices between 100 and 101, correct? So it could be 100.05, 100.10, 100.15, 100.20, and so on, correct? Depends on what is the tick size. Tick size means the minimum amount by which the price can go up. So one tick maybe is 0.05 in this case, whatever. So there are multiple prices between 100 and 101. That's a 1% distance. My goal is when the price starts to go up, I want to buy the stock in that yellow band. Okay. Now, sometimes what happens is, let's say I have a meeting in office when the market opens. Maybe I'm a working professional. I have a salaried job. Maybe I'm a commercial airline pilot, whatever. But I know that during the time when market is open, I might not be available at the screen or my laptop. In that case, what I could do is I could place a GTT buy order. So, for example, this now becomes a GTT buy order. GTT buy order means I want to buy the stock as soon as it touches 100. So trigger price is going to be 100. Obviously, you learned from the previous video. So in this case, we are buying, we are not selling. So trigger price is 100. So when the price reaches 100, which is our buy point, that's the trigger. The broker will send your order to the exchange. Now, what does that order contain? That order contains quantity. So let's say the quantity is again 335 shares, as I discussed in the yesterday's video. So it's 335 shares which I want to buy. Now, what should be the limit price? Okay, now let's say the limit price is 100. Okay, now there is a problem with this order. What's the problem? Well, when the price touches 100, at that time, your broker is sending this order. to the exchange. In this order, what you are saying to the exchange is that I want to buy 335 shares of this stock at a price which is 100 or less than 100. Okay, I am not willing to pay more than 100. Remember, this is a buy order, this is not a sell order. So when you place the limit price, you say that this is the maximum I am willing to pay. Okay, in sell, it was different. In sell, you don't give the maximum price, you give them the minimum price, because it's the minimum price at which you want to sell. This is about the maximum price I am willing to pay. Okay, so 100 is the maximum price. Now let's say when the trigger occurs, after that, by the time this order reaches the exchange, what if the price is 100.05? What if the price is 100.10? Now your order will not get executed because you are willing to pay only maximum 100 rupees. Correct? So that is the reason why you place this at 101. Why 101? Why not 102? In the GTT sell order, we kept 2 rupees as the distance. In this case, why are we not keeping the limit price 2 rupees above? Because as per our trade execution strategy, we don't want to buy the stock more than 1% above that yellow line. In that range, it is fine, but not more than 1%. So when the trigger occurs, let's say the price suddenly shoots up to 102 at the time when the trigger occurs, and by the time the stock reaches the exchange, I'm not going to buy the stock at 102. 101 is the maximum price I am willing to pay. Anything at 100 or below 100, sorry, anything at 101 or below 101 is fine with me. So imagine this, the stock hits 100, the trigger occurs, this order reaches the exchange, you have specified the maximum price as 101. By the time this order reaches the exchange, the price is, let's say, 100.25 or 100.35. The order will get executed because you placed the maximum price as 101. 100.35 is less than 101. So your order will get executed. So now you understood why the limit price has to be higher than the trigger price. Okay, in sell, why the trigger price has to be higher than the limit price? It's the order. When the order goes to the exchange, you want to be protected. You want to be dealing with the market on your terms. Okay, now this is one thing. So let's say you put this GTT order. Let's say you are a commercial airline pilot, or you will be in a meeting during in the whole day in office. You can't catch the stock exactly at the price when it is crossing that yellow band. So this GTT order will automatically pull you into the stock. So money will get debited from your account and you will get the stock. Correct? Now, what's the risk in this? Well, obviously there is risk. What if you are not available during the day in the market? The price touches 100, the order gets triggered, you placed your limit price well, you buy 35 shares, the shares come to your account, and then the stock starts falling. That's the risk, right? So how do you control that risk? Well, there are two ways to control risk. I have told you countless times there are two ways to manage risk. Number one, reduce your position size. Number two, keep your tight stop loss. Now, can you reduce your position size when you are in a meeting? Can you reduce your position size when you are a commercial airline pilot? You can't do that. You don't have access to internet. You can't reduce your position size after you bought the stock. You cannot keep a stop loss. You don't have access to the internet. You're not in front of the PC or your laptop. When will and how will you keep the stop loss? So keep reducing position size is out of the question. Keeping tight stop loss is out of the question. The best you can do is, let's say your plan is to buy 335 shares. Instead of buying 335 shares, buy like half, like buy like 100 and what, 120, 130 shares maybe, or buy like 25% of 335, maybe 70, 80 shares, right? I am saying buy less amount than you actually plan to buy. So if your position size is, let's say, 6.25% of your portfolio normal, put 3% of your portfolio in this order. Now of course, there is a huge risk that 3% could collapse 8% after hitting your buy price. But When if you're working in office there, you will get some time, right? Maybe you go to the washroom, you quickly take out your mobile phone, see whether the order is triggered, quickly keep a stop loss, go back to your meeting. If you're a commercial airline pilot, at some time you will land, right? When you land, quickly check whether your order got triggered, quickly put a stop loss. You will get the time. And generally for this strategy, chances are very low that a stage 2 uptrending stock will hit the buy price and at the same day fall back 8%. Chances are very low because the stock is already in a confirmed uptrend. I am not saying it will not happen. I am saying the probability of that happening is very low. When in the same day it goes up and then crashes 8%, generally the stock fluctuates near that yellow line. Now, if it's a swing trade where the fundamentals are weak, okay, of the stock, there is a good possibility that it will touch the yellow line and immediately crash on the same day, 8%, kick you out of the stock. Correct? Can't do anything for that. You don't have any option. If you want to buy the stock, you will have to do this. Now, sometimes another application of GTT buy order is sometimes this distance is so small, the closing price and the buy point is so small that if there is a sudden price hike, sudden price increase, you don't want to miss out on that stock. If you manually go to buy the share in that band, it's not possible because the price is moving so fast. So in that case, putting a GTT buy order gets you into the stock in time. Okay, so if it's a positional trade, great fundamentals, great liquidity, great comparative, great technicals, confirmed uptrend market conditions, fantastic. In that case, go ahead and put the GTT order, especially if you are watching the stock, especially if you are in front of the PC. Your GTT order will ensure that you get some shares. Okay, if not 335, at least you might get 300 shares. Some of your shares might not get filled in because the stock is moving so fast. Okay, that's the application of the GTT buy order. So remember, use the GTT buy order for specific applications. Use the GTT order for specific applications, which I have discussed in this and the previous video. Thank you so much.